into this special show on Money Control. I'm Karunya Rao, and as promised, we will talk about the market sell off. It's been a heartbreaking start to the week, I'd say. Benchmark indices have turned negative for the year 2022, a complete reversal of any kind of gains or any kind of uptick that we witnessed. Markets did post the biggest single day fall in the last 10 months. The signs, the cues that we're picking up from around the world also looking quite weak and quite alarming at this juncture. So let's talk fundamentals and technicals eventually in the show as well. To talk fundamentals, I have Mr. Sanjay Dutt joining me today. Thank you so much, Mr. Dutt, for taking time out.
Welcome. Good to have me here. Thank you so much. Thank you for having me here.
So, can you tell us what exactly is happening? Because a lot of retail investors in the street are baffled by the kind of downturn we've seen on the benchmark indices. Many of them are new investors, and if anything to go by, the last couple of months have been quite resilient and quite stable. So, this is the first time many of the people, on the street are witnessing such a turmoil.
Yeah, currently, an important point for everyone to realize right now is contrary to what was happening since March 2020 when we had the post pandemic rally starting off, this is the first time beginning October, November when actually across asset classes adjustments are taking place. To de jargonize that, we are now coming to a phase where liquidity is getting reduced in the system because what happened in March when the pandemic hit up, March 20 when pandemic hit us, all central bankers and governments across the world tried to stabilize the financial system and financial markets. More than the financial system and financial markets, their objective was to stabilize businesses so businesses don't fold up, which obviously has an effect on each one of us, whether it's savers or investors or people who lend money to the banks. So I'm trying to make it very basic. However, from October, November onwards, a little before that, the the loose monetary policy or the policies that were followed by the banks started to have negative impacts on the global financial system because there was excess liquidity, but the supply chains across most industries had not normalized. So we got hit by a double whammy. One being that industry and the logistics and the supply chains not normalizing, so therefore supply of goods and services as a whole were problematic still. And second being that we had excess liquidity, and the combination of two started leading to inflation. Across the world, asset prices, consumption items started to get more expensive. I'm trying to be very
Hmm.
simple, actually, not to complicate the whole thing. So as soon as this kind of an impact started to happen, we started to see a substantial repercussions on financial markets, particularly equity markets, because equity markets are always fueled by liquidity. Liquidity flows in, it becomes easy to make money, people start trading in and out, it becomes easy to trade assets, industry gets money easily. So is that adjustment which started happening, and we are seeing that adjustment that's playing out. It's not really that much of Ukraine, etc., etc. But it's basically this interest rate, inflation,
Hmm.
loose monetary policy, fiscal imbalances, those adjustments that are happening now to normalize the system.
So, how much longer will this turbulence last? Because earlier on, when markets used to witness some periods of temporary blips or downturns of of a similar kind, people would be more optimistic that okay, it's just a couple of days more and things will look better, and we could shrug off the pain. But this time around, it has really lasted a while.
That's right. But we must understand that the primary trend of fabric of the market, I won't say primary trend, but the fabric of the market, particularly across most markets, including India and emerging markets also included in that. The entire fabric has changed now compared to what it was we saw during those periods of March 20 till about middle of last year. People have forgotten the period before March 20, because what I would understand, a large number of investors, particularly retail investors and small people, have come into the market after that to enjoy this kind of a secular rally or a one-way rally that is taking place. So most of us who've been in the market for 2 or 3 decades have seen this kind of story play out. The market takes time to adjust. This adjustment process normally lasts a few months. And also, while this adjustment is happening, a new set of asset classes, within this asset classes, a new set of stocks, a new set of sub asset classes starts to perform while the others underperform. And that's exactly where market participants are trying to find balance so they can adjust to a new normal that's started to play out now. And that new
Hmm.
normal, as the appears a little evident right now, if I focus it to a very micro aspect as the equity markets, is that the growth versus value debate. In the sense, everything that was focused on growth, internet, new technologies, irrespective of cash surpluses or not, those kind of equity stocks were doing well. Now we are seeing focus is shifting towards value, looking at valuation of companies, looking at valuation of sectors, hard asset businesses, cash flow generating businesses. So, to cut a long story short and come bang on to your question on how long it's going to take, no one can really game it. But my own estimate is a quarter or two of volatility will carry on.
Hmm.
We will reach a period of dull consolidation, and then a new set of stocks will appear, which will continue this growth phase. This bull market is here to stay, except the leadership probably will change. That's what I think will happen over the next few months.
Okay, so you were talking about, the increased focus on value. Where do you see value at the current juncture?
See, I'm quite clear that the focus is now on to companies which have hard assets on their books, companies which have cash flows, which are generating cash, are not burning cash as what we saw. I'm not saying that the models of Zomato, Paytm, or Nykaa, the ones who are burning cash, those models are defective or those models are going to collapse. But the focus is now going to shift more on the traditional company, the traditional models, which will generate cash, employment, assets. So, to coming to specifics, I would look at manufacturing plays, infrastructure plays, some non-ferrous metals, which are key ingredients or key inputs in various industries. Real estate plays. Real estate is coming out of a long bear market or long consolidation phase. So money is going to start moving into these kind of places, which we're already seeing. And people are start going to go underweight on growth sectors where there's going to be substantial cash burn. I really doubt if we are going to have many successful IPOs which are coming to the market with negative cash flows, in the sense of burning cash just to get the numbers or based on GMBs, etc. But people are going to focus on hard asset businesses. I'm repeating this again and again. But
Hmm.
people are going to focus on manufacturing, selective metals, real estate, uh, you know, some media companies which are generating cash. Broadly, the theme being that cash flow generating businesses at fair valuation or attractive valuation. And even there, very high valuations are not going to be paid for anything.
Okay, all right, understood. But from an actionable standpoint, Mr. Dutt, before we let you go, is this a market where you buy the dip or you sell on rallies?
Very good question. Buy the dip is not a 1 day process, really, or not a 1 day kind of a job. If I see a 500 point dip and I buy it today, and similarly, selling out our portfolios or moving out and realigning our portfolios when we've seen something that's given us stupendous return is again not a 1 day job, because you normally tend to phase out and phase in. So when now this is a period of phasing in to places which are attractive, but you start dibbling, you start dipping in your toes in the water, start buying a little bit, keep watching, identify your stocks, identify the places you want to be. say you've done 25-30% of your buying today, watch again tomorrow, let the market settle a little, let the volatility die out a little, let there be calmer waters, and then keep adding. And this is a strategy I'm advocating this strategy for investors. I'm not in a position to talk about anything that's 15-day, 1 month, or 3 month, or 6 month kind of a trading position. I'm purely talking from an investor standpoint that you start nibbling in, you start buying, you start allocating capital slowly as you see attractive levels coming in.
Any message that you'd like to give to new investors who have, started participating in the markets in the last couple of months? Because a fair amount of people of this particular section is very worried because it's not something they've witnessed before. So, how to tackle these times of uncertainty? Any tip there?
Yes, I think they need to be patient. They need to understand this is not a 1 day, 15-day, or a 1 month game. The go-go days and the momo days, the momentum days are over probably. Easy money has been made in the last 1.5 years, 2 years. Now we've got to get down to some serious stock selection, serious sector selection, and pick up things to buy. And do it slowly. You will not miss anything. You will get your prices. Just slowly keep buying. And remember, your investment horizon should be minimum 12 to 24 months and nothing lower than that. In fact, I personally do not invest into anything that I don't intend to hold for about 3, 5 years. But
Hmm.
if in the short term I make unexpected gains, then I exit. But ideally, I invest only for 3 to 5 years, or even some stocks I've invested and remain invested in about 8 to 10 years. Now, it's very difficult for new entrants in the market to really digest this, that they will be buying something and staying put for 5 to 8 years.
Okay, point taken. Mr. Dutt, it was a pleasure having you on board. Thank you for helping us understand, the market route that's playing itself out and how new investors can calm their nerves and how they should position themselves among all this volatility. Thank you for joining in.
Thank you.
Let's move. Yeah.
3, 2, 1,
Welcome back. We're still doing our special programming to help our viewers and all the new traders and investors out there to understand what's happening in the market, the sell off, the major rout across the key global markets, and how Indian markets are stacked against that. Rajesh Palviya joins me from Axis Securities. Rajesh, thank you for taking time out.
Yeah, good evening. Thank you. Thank you for having me
Thanks.
on this show.
We were talking about how this is a market where you should buy the dip or whether you should sell on rallies. Going by the charts and the levels at which we are, whether it's the Nifty 50, the Bank Nifty Index, what will be your verdict?
So, Karunya, if we go with the chart, this is the first time Nifty is now approaching towards the 200-day moving average. We have tested this 200-day moving average in the month of September 2020, and now again we are revisiting after a strong rally towards 18,600. Now coming back to the 200-day moving average, which is really worrisome, sign for the market, because almost today's close is almost very close to 200-day moving average. If we breaks that level, then possibly we can see further more downside from the current level. Even if we look at the last 6 month move of the Nifty, almost we were consolidating in a broader range of 16,600 to 18,600. This was the range, but now looking at the sell off, which is happening, which is giving sign that in this fall we might break this range, and Nifty can go further down towards 16,400, even 16,200 can be the lower side level on the Nifty. So because this time in this fall the IT index is giving more pressure compared to the bank nifty. Bank nifty is still outperforming if we compare with other sector, but IT index which has created more pressure on the nifty, and that's the reason now we are underperforming in terms of nifty compared to the bank nifty. So looking at the sell off, now we are very close to 200-day moving average, which is almost near at 16,790 zone. If we breaks that level, then possibly another 200 300 point fall we can see in this continuation. Another important factor on the negative side, that is India VIX, which is almost rose by around 25% in today's session, and now we are trading at 23 plus level for India VIX, which is clearly sign of fear in the market. And none of the sector, none of the large cap stock is able to hold 100-day, 50-day moving average. So which is again a negative sign for the near term to short term, and we feel that some more selling pressure is going to continue. So it's a sell on rise until unless we're not able to cross above 17,600. Whatever pullback we are getting in the near term should be used as a selling opportunity in the market.
Rajesh, can you help us understand why is it that the banks specifically were under tremendous pressure? Yes, we saw broad-based selling, but look at the quantum of losses that PSU banks and even the entire banking space has witnessed today, 5% lower. Quite a beating, I'd say.
Yeah, so banking sector, financial sector is high beta, and it's a rate sensitive sector. And whenever we generally see volatility from the global cues and FI selling, so generally we see this kind of sell off in the banking space, and the same behavior we are witnessing in the banking space. In today's call, Bank Nifty is now trading below 100-day moving average, which also a negative sign on the Bank Nifty. And now we are approaching towards the 200-day moving average for the Bank Nifty also, almost 500 point away from the bank 200-day moving average in the Bank Nifty also. So the kind of sell-off we have witnessed in the private bank as well as in the PSU bank, it has again given the breakdown on the near term as well as on the short term chart, and the breakdown which has happened on the all large cap banks is suggesting that that furthermore another 5 to 6% cut we can see in the in individual stocks as well as in the bank nifty also. Maybe possibly if we break below 36,500 for bank nifty, possibly it can further down, it can go further down towards 35 800 to 35 500. This could be the possible range we can see, because in the today's session a lot of put writers have shifted their position at the lower strike. which clearly shows that the range for the monthly series for the Feb series also shifted lower, and now Bank Nifty put writers have shifted towards 36,000 as well as 35,500, which clearly shows that we may see further more pain in the private bank as well as PSU bank, which can take Bank Nifty further lower towards 36,000, 35,500 from the current level.
Okay, I'd like to also, flag off to our viewers who are watching us live. If you have any questions, you can definitely bounce them off to us on our YouTube live stream. But Rajesh, it's quite interesting. The only stock that shut in the green today was TCS. Of course, there is some news flow associated to that. But overall, IT Pack did turn a bit of an underperformer in the recent past. So, can you shed more light on the technicals? Will this phase continue, or do you expect a bounce back there?
Yeah. So in the near term, yes, we have seen some bit of pressure in the IT stocks, and most of the IT stocks from large cap as well as from the mid cap have corrected significantly. But still, if we analyze the longer picture, if we analyze the long term setup for the IT stock, they are still in the bullish zone. So we believe once this sell off across the globe happening, and once this settle down somewhere. Yes, definitely IT stocks are well positioned, and the long term setup for most of the IT stocks are in the bullish zone. And we believe that again pullback action and bounce back will come in the IT stocks. So this dips and this corrective action is an opportunity to buy good quality IT stocks, because most of the IT stocks from large cap like TCS, Infosys, even Tech Mahindra, these stocks are trading near to their multiple support zone. And if we analyze from the long term setup, most of the stocks are holding their long term strength on the chart. So my belief is that once this selling pressure settle down at certain level, so these IT stocks are opportunity to buy in the dip. And my belief is that TCS, Infosys, Tech Mahindra, these three stocks are looking attractive based on their long term setup, and one should use this dip as a buying opportunity in these three stocks.
Okay, all right. You also, were speaking earlier about Reliance Industries. Any interesting observations on that counter?
So if we analyze the Reliance industry, in this sell-off, if we look at the Reliance industry setup, stock is, consolidating in very narrow range. And now looking at the short to medium term setup, stock is holding its, earlier breakout, which was happened at around 20 to 80 level. And multiple times stock has taken the support and shown good bounce back action from those levels. So in the current setup, again, looking at the Reliance setup, it's almost trading near to its important multiple support area, and we feel that if stock continues to hold about 20 to 80 level, it's an opportunity to buy the stock. And once the stock manages to cross about 2400 level, then possibly we can see furthermore upside momentum towards 2480 to 2500 level. So in the large cap space, Reliance is looking something interesting, because whatever sell off is happening in other sector in the index, but Reliance is showing different behavior, and the kind of buying action which we are seeing in the stock at lower level, it shows that stock may perform in the near term once the market selling pressure settle down at certain level, and possibly we can see 2450, 2480 kind of level in the Reliance.
Okay. Another heavyweight that was, in focus a fair amount was Maruti Suzuki, and after a very long time, it breached significant levels. I think when was the last time? I don't even remember when we saw Maruti breach that 9,000 mark. Do you think this, ride up for this stock will continue, or do you expect some kind of resistance on the way to 10K and beyond?
So, Karunya, if we analyze on the automobile pack itself, auto index is moving in upsloping channel on its weekly chart, and most of the automobile stocks has shown good buying interest in last couple of months, and some of the stocks managed to give breakout of their near term as well as on the short term chart also. But in recent sell off, some of the stock again trading below their breakout level. So looking at the Maruti, look at Escort, Tata Motor, Eicher Motor, even Hero Motor, these all stocks has shown good buying interest in recent past. Especially if we talk about the Maruti, the setup which is there on the monthly chart, stock managed to give its multi-month breakout in the recent past, and even in this decline, stock is able to hold that breakout level. The kind of breakout which we have seen in the Maruti chart on the long-term setup, we believe that Maruti is having a strong setup across all time frame, and we feel that the setup is suggesting that upside target around 9500 to 10,000 in the longer run. So one can use these dips as a buying opportunity. We suggest to buy Maruti in this decline, keep stop loss of 7800, but our long term target for Maruti is around 9500 to 10,000. So one can buy in a staggered manner, use this opportunity to accumulate the Maruti in this recent fall.
Amid all the mayhem that we've seen in the market for the last few weeks, what will be some stocks that still look very strong and very resilient on the charts? Any of
So,
your favorite picks you have right now, which look extremely poised to do well?
So some of the metal stocks are clearly showing, strength in the recent time. Stock like Vedanta, Hindalco, NMDC, even from mid-cap space, Mathan Alloy, these all stocks are, looking very attractive. And if we take the view from the metal space, so it's a mixed behavior we are seeing in the metal space, but non-ferrous like, Vedanta, Hindalco, NMDC, these all stocks are looking very attractive. So our preferred pick from this space is Vedanta, and we are expecting that 430 to 450 could be the possible target in the Vedanta in going forward. So one can buy and accumulate Vedanta because across all time frame stock is in bullish zone, and one should use this volatility to buy the stock. Keep stop loss of 330. Another stock which we like, that is NMDC, and NMDC, if we look at the setup, on the weekly setup, almost a consolidation of 2 3 months, and now breakout is already there on the weekly chart. And the chart pattern suggests that we can see upside momentum towards 175 to 180 in NMDC. So one can buy and accumulate NMDC with
Right.
stop loss of 130. This is another stock which we like.
Just one last question, Rajesh, before we let you go. A couple of our viewers have also posted about this. For the next, 1 to 2 months time horizon, if they want to invest in the Nifty 50, what are some levels that they should be keeping on their radar?
So for Nifty, my belief is that 16,700 to 16,500 is a good support area. If Nifty comes around those levels, one should start buying in. And once again, Nifty manages to cross again 17,300, 17,400, they can start investing more, because that would be again comfort zone for the market on the short term perspective also. So on the decline, 16,700 to 500 is the buying zone for the Nifty. For Bank Nifty, my belief is that 36,500 to 36,000 is the area where one can start buying in Bank Nifty also. So these are the two important level which I feel that again my market will start getting some support buying around these levels.
All right, Rajesh. Then thanks much again for joining in and helping our viewers understand what are the critical levels that they should be watching out for from a trading standpoint, and what are some stocks that offer value at current levels. Thanks once again for taking time out, and thank you to all our viewers for tuning in as well. Have a great day.